You get the keys, you take the porch photo, you think the hard part is over, then the letter hits, your escrow is short, your payment is being adjusted, and it's not by 20 bucks. It's the insurance line item that detonated. Homeowners insurance has become the silent rate hike that shows up after closing, when you have the least leverage and the most to lose. This isn't a coastal problem anymore. According to Zillow, premiums are up 38% nationally since 2019, while median homeowner income rose only 22%. According to the Consumer Federation of America, the typical homeowner was paying about $3,303 a year by 2024. After an average increase of $648 from 2021 to 2024, that gap doesn't just pinch households. It pushes debt-to-income ratios over the edge and turns affordable listings into traps. The deal impact is already visible. Real Estate News reported that insurance-related transaction cancellations in California nearly doubled between 2023 and 2024. HousingWire, citing a Value Penguin survey, reported that 67% of policyholders saw rate increases in 2024, and many of those hikes were 10% or more. Buyers hesitate. Sellers eat credits. Investors redo pro formas, lenders tighten. If you're in real estate, this is the new choke point. A transaction can still die because the insurance quote arrives like a bill from the future. Once it hits escrow, it spreads through the whole market fast. If you work deals for a living, you've felt it. The insurance quote is now showing up like a second appraisal, except it doesn't care what you paid, it cares what it thinks the next decade is going to do to that property. A premium jump can erase affordability faster than a rate move, because it hits the escrow every month and it doesn't refinance away. According to a Zillow analysis published in 2025, homeowners insurance premiums have grown 38% nationally since 2019, while median homeowner income grew only 22%. That mismatch is not a headline problem. It's a closing table problem, and it's getting normalized. The Consumer Federation of America found the typical homeowner was paying about $3,303 per year by 2024, after an average increase of $648 from 2021 to 2024, with premiums rising in 95% of zip codes. When that kind of pricing moves from Florida story to almost everywhere, lenders start asking harder questions. Buyers start failing DTI by inches, and operators start reworking the whole underwriting stack: replacement costs, deductibles, exclusions, wind, hail, water, wildfire, all of it. The market is already reacting. Real Estate News reported that in California, insurance-related transaction cancellations nearly doubled between 2023 and 2024. HousingWire, citing a Value Penguin survey, reported that 67% of policyholders experienced rate increases in 2024, and a big share of those hikes were 10% or more. That's the kind of friction that slows sales volume and changes migration patterns. If you want more reporting like this data first deal relevant, hit like and subscribe. It's what keeps these deep dives coming. And for transparency, every data source referenced in this video is listed in the description. The first mistake is thinking this is just companies jacking prices. What actually happened is uglier. The math of loss got rewritten, and it stayed rewritten. Over the last decade, the US racked up a steady drumbeat of disasters that used to be outliers and are now just Tuesday. According to NOAA's billion-dollar weather and climate disasters tracking, the long-run average from 1980 to 2024 is $9.0 billion events per year, CPI adjusted. The average for the most recent 5 years, 2020 to 2024, is 23.0. That number matters because insurers don't price your policy based on vibes. They price it on expected loss. And expected loss is being forced upward by frequency. The trap for real estate people is that we still talk about hurricanes and wildfires like they re-niche. The market's real blood loss has been coming from the so-called secondary peril: severe thunderstorms, hail, straight-line winds, tornadoes, the kind of stuff that hits places that never considered themselves insurance hotspots. Swiss Re has been blunt about this shift. It estimated insured losses from severe thunderstorms hit an all-time high of about $60 billion in 2023. In its Sigma research, Swiss Re goes further and calls severe convective storms the second largest loss-making peril after tropical cyclones, noting 2023 insured losses of $64 billion and that most of those losses originated in the US. That's not a Florida-only storyline. That's a national pricing reset. Now stack on the second punch. Even when the peril doesn't change, the cost to put the house back together did. Replacement cost is the heartbeat of homeowners insurance. When labor is tight, materials jump. Permitting gets slower, supply chains wobble, and contractors are booked out after regional catastrophes. Claim severity rises fast. The homeowner experiences it as my premium doubled. The carrier experiences it as the same roof claim costs 40% more than it used to, and it's happening more often. This is why the premium increases show up in places that didn't have a headline disaster last year. The cost basis underneath the entire book moved. You can see the pricing logic leaking into real estate research now because insurance is no longer a side expense. It's a risk signal. Zillow's 2025 analysis found premiums up 38% nationally since 2019, with the fastest growth in places with higher climate risk. That's insurers saying, in dollars, we don't like this zip code the way we used to. And Realtor.com/2025 Housing and Climate Risk Report puts a sharp edge on what that means for housing economics. In the top 100 metros, Miami had an HO3 premium to market value ratio of 3.7%, with New Orleans at 3.6%. Read that again, like an operator. In some markets, insurance is functioning like a recurring tax on value, and it scales the wrong way, hurting lower value, higher risk markets the most. Behind the scenes is the third punch that consumers almost never see: reinsurance. Think of it as the insurer's insurance, the wholesale layer that protects balance sheets when catastrophe clusters. When reinsurers raise prices or pull back capacity, primary carriers either eat it, which they want T for longer, they push it down the chain into higher premiums, higher deductibles, and stricter underwriting. This is how you end up with buyers getting quotes that look normal one year and absurd the next, with no visible change to the property. It's not personal. It's capital getting more expensive. So the why of the last decade isn't one event. It's a cycle. More frequent loss, higher claim severity, more expensive capital to backstop the risk, and then a national repricing that spreads from the obvious states into the quiet ones. If you're buying, selling, lending, building, or investing, the warning is simple. Insurance is no longer just protection. It's a forward-looking market price for risk, and it's already rewriting which deals pencil and which deals die. The second mistake is thinking higher prices are the whole story. In a lot of markets, the real disruption is availability, not just cost. When carriers stop writing new business, cap exposure, or quietly non-renew blocks of policies, the premium becomes whatever the last willing underwriter says it is, or whatever the insurer of last resort can offer. That's how you end up with perfectly clean homes getting treated like toxic assets, because the zip code is in the wrong shading on a model. California is the easiest place to watch this happen in real time. The Turner Center at UC Berkeley has been documenting how homeowners are increasingly pushed toward the FAIR plan when traditional coverage isn't available, especially in wildfire-exposed areas. The California Department of Insurance's own FAIR plan fact sheet shows the scale of the shift. FAIR plan policies grew from about 1.6% of the residential market to 3.7% by 2023, and the FAIR plan reported 49823. More new and renewed policies in 2023 than in 2022, 18% jump in 1 year. That's not a rounding error. That's a parallel insurance market forming underneath the normal one, and it doesn't stay contained. Once more risk is warehoused in a state-backed plan, private insurers get assessed to fund it, capital gets stressed, and underwriting tightens again. It's a feedback loop that looks a lot like other moments when markets learned late that risk was It's not 2008 for insurance, but the rhyme is familiar. Cheap coverage encourages development in riskier areas. Losses rise, capital retreats, prices jump, and then everyone acts surprised that the old pricing was fantasy. Florida adds another accelerant to litigation. According to the Florida Office of Insurance Regulations, Residential Property Claims, and Litigation Report, in 2022, Florida represented 14.9% of nationwide claims, but 70.9% of the nation's property insurance litigation. That kind of legal load doesn't just raise premiums, it changes behavior. Carriers restrict coverage, raise deductibles, and hunt for reasons to avoid writing new policies because they not only pricing storms, they repricing courtrooms. Even where reforms are now pushing litigation down, the market doesn't snap back overnight because reinsurance reserves and underwriting appetite are all slow to forgive. For real estate operators, this is where deals start dying in dumb, preventable ways. Insurance is now a precondition, not a post-closing cleanup. Real Estate News reported that in California, insurance-related transaction cancellations nearly doubled between 2023 and 2024. That's the kind of friction that doesn't show up in median price charts, but it absolutely shows up in volume, days on market, and renegotiations. Buyers request credits, sellers push back, lenders ask for binders earlier. Escrow officers start sounding like risk managers. The other piece people miss is how underwriting has shifted from what is this house to what does this location imply. Credit-based insurance scoring is part of that story too. Real Estate News flagged how, in some cases, credit scores can influence premiums more than the actual climate hazard, with disproportionate effects on lower-income buyers. If you're a broker or loan officer, that means two borrowers looking at the same property can be quoted to different realities. The house didn't change, the spreadsheet did. Then there's the slow creep of coverage that exists on paper, but fails you under stress. As premiums climb, insurers push higher deductibles, carve-outs, and separate wind-hail structures. Buyers think they're insured. Then a storm hits, and they discover the deductible is 5 figures, or that a common loss type is capped. And when claims disputes rise, litigation rises too. A recent Financial Times report noted homeowner insurance disputes increasing from roughly 1,600 in 2016 to more than 4,000 in 2025, excluding hurricanes, another signal that this system is grinding. So the second chapter of this story is not just climate and construction costs, it's market mechanics, carrier pullbacks, last resort plan growth, litigation pressure, underwriting rules that reprice whole neighborhoods at once, and transaction pipelines that weren't built to handle insurance as a gating item. If you're still underwriting deals like insurance is a stable line item that rises a few percent a year, you're underwriting yesterday's market. The new one punishes assumptions fast, and it doesn't care whether your buyer loves the house. What do you do with this? If you're a homeowner, a buyer, or someone who lives inside transactions, you stop treating insurance as paperwork and start treating it like a pricing engine that can break a deal after every other box is checked. If you're buying, get the quote before you write the offer, not after inspection. Ask for the full structure, replacement cost, not market value, wind and hail deductibles, whether water backup is included, whether roof payment is actual cash value or replacement cost, whether there's a separate wildfire deductible. If the premium looks fine, stress it anyway. Run a scenario where it jumps 20% at renewal and ask yourself if the escrow still works. That not paranoian, OAAS data shows the last 5 years have averaged $23 billion disasters a year, compared with 9 a year on the long-run average. The odds of your region getting tagged by a costly event are simply higher than they used to be. If you already own, the cheapest win is often mitigation that insurers recognize. Roof age and roof type matter. Even if your carrier won't discount today, the next underwriter might. And you're building insurability, not just savings. If you're an agent, lender, or investor, change the workflow. Make insurance shopping part of the first conversation. Keep a list of brokers who can move fast. Underwrite deductibles as real cash risk, not just fine print. When you model rentals, don't assume insurance tracks inflation. Assume it tracks risk and capital. Zillow's analysis showed premiums climbing faster than income nationally since 2019, a mismatch that squeezes affordability even if rates stabilize. And watch the last resort indicators in your target markets. The growth of FAIR plans is not just an insurance story, it's a liquidity story. In California, the FAIR plan's share rose from about 1.6% of the residential market to 3.7% by 2023. When more homes rely on backstop coverage, the market is telling you private capital doesn't like the risk at current prices. All the sources for the data cited in this video are listed in the description. Now I want your read. In your market, is the bigger threat the premium itself or the moment you can get a policy at any price? Drop your city and state in the comments, and if you want more reporting like this, hit like and subscribe.